bonds. Okay, that word can sound, well, pretty intimidating, right?
Yeah.
Like it's full of complex secrets.
It really can.
But today, we're actually going to pull back the curtain, see what's really going on.
Yeah.
Think of this as your personal guide to understanding how bonds are priced and traded. No finance degree needed.
That's exactly the plan. We want to simplify the core ideas behind these, fixed income securities. We'll look at how their value is determined, what makes prices move, and just the basics of how they're bought and sold. We're using materials you shared, so this is really tailored to get you up to speed on, well, what actually matters.
Right. Forget feeling overwhelmed. Our mission here is really to extract the key insights, those aha moments, so you can navigate the world of bonds feeling confident. We want you to finish this conversation feeling informed and, empowered. Okay, let's dive in.
Let's do it.
We're starting with the absolute foundation, calculating bond prices and yields.
Okay. And at the heart of bond pricing is this concept called present value, PV. It's actually a pretty intuitive idea. What is a future amount of money worth right now, today?
Right. Like, would you rather have $100 today or $100 a year from now? Easy choice.
Exactly. Most people take it today because, well, you could invest it, maybe earn a bit more, or just use it now. That difference in value between money today and money later, that's what PV captures.
Makes sense.
So let's take a simple example. Imagine you're promised $1,000, but 1 year from now.
Okay.
If you knew you could invest money today and earn, say, a 5% return, how much would you need to invest right now to end up with exactly $1,000 in a year?
Okay, let me think. If I invested $900 today at 5%, that's $900 plus $45. So $945, not quite $1,000. Need a bit more upfront.
Exactly. The formula is basically present value times 1 plus the interest rate equals the future value. So PV times 1.05 equals $1,000.
Right.
If you solve for PV, you get $1,000 divided by 1.05, which is about $952.38. So $952.38 today, earning 5%, grows to $1,000 in 1 year. That $952.38. That's the present value of that future grand.
Got it. So future money is worth less today because of that opportunity cost, that potential to earn interest. Now, how does this apply to bonds? Because they have, multiple payments, right? Coupons and stuff.
Well, a bond is really just a stream of future cash flows. You get regular interest payments, those are the coupons, and then at the very end, you get your initial investment back, the principal or face value.
Okay.
So to find the bond's price today, we need to figure out the present value of every single one of those future payments and then just add them all up.
So it's like taking each coupon payment and that final principal payment, figuring out what each is worth in today's dollars using some interest rate.
Exactly. The discount rate.
The discount rate, right. And then adding all those present values, that sum is the bond's price.
You've got it. There are a few steps. First, we figure out the right discount rate to use. This reflects current market interest rates for similar bonds, similar risk, similar maturity.
Okay. Then, for each future coupon, calculate its PV. Then do the same for the final principal payment. Add them all up. That gives us the bond's current fair price.
And I bet there's a formula for this, too, something a bit more formal.
There is, yeah. The general formula looks a bit like this. PV equals C divided by 1 plus R to the power of 1 plus C divided by 1 plus R squared, and so on. All the way to the last coupon C divided by 1 plus R to the power of N, PLUS the face value FE, divided by 1 plus R to the power of M. Whoa, okay, that looks mathematical. Let's break that down.
Absolutely. PV is the present value, the price we want. C is the coupon payment you get each period.
Got it.
R is the discount rate per period. N is the number of periods. And FV is the face value you get back at the end. So the formula is just, discounting each future payment, all those C's and the final FV back to today's value and summing them up.
Okay, so R, that discount rate, is super important. And you often hear discount rate and yield used kind of interchangeably here. How's that different from the coupon rate the bond started with?
That's a really crucial distinction. The coupon rate, that's fixed when the bond is issued.
Yeah.
If it's a 5% coupon on $1,000 face value, it pays $50 a year, period. Doesn't matter what the market does.
Right.
Fixed. The discount rate, or the yield, though, that's set by the market, is what investors are currently demanding for that level of risk and time. So coupon's fixed, yield fluctuates.
So, okay, coupon is the promise, yield is the current market reality. And that difference explains why bond prices change, right? If the market demands a higher yield than the coupon, the price has to fall to make up for it.
Exactly. Perfect. To really see this, let's use a detailed example. Imagine a 4-year bond. It's got a 9% coupon rate, $100 face value.
Got it. 4 years, 9% coupon, $100 face.
Now, let's say the current market discount rate, the yield investors demand for similar bonds right now is 10%.
Okay, so market wants 10%, but the bond only pays 9%.
Precisely. And one more thing, this bond pays its interest semi-annually, twice a year.
Okay, semi-annual. So instead of $9 once a year, it pays $4.50 every 6 months. And over 4 years, that means 8 payments total, 8 periods.
You nailed it. So the coupon payment per period, C, is 9% divided by 2 times $100, which is $4.50.
Yeah.
The total number of periods, N, is 4 years times 2 periods per year equals 8.
Right.
And the discount rate per period is the market's 10% annual rate divided by 2 equal 5% or 0.05.
Okay. So 8 payments of $4.50 every 6 months, plus $100 back at the end of year 4. And we need to discount all that back using that 5% semi-annual rate. How do we calculate what that whole stream is worth today?
We need the present value of each $4.50 and the present value of the final $100 principal, all using that 5% discount rate, and then add them. So that first $4.50 in 6 months, its PV is $4.50.
Okay.
The second $4.50 in a year.
Yeah.
PV is $4.50 and $1.05. You do that for all 8 coupons.
Right.
And finally, the $100 principal at the end of 4 years, that's worth $100 and $1 over 5/8 today.
Okay, that sounds like a lot of individual calculations. Is there a shortcut?
Yeah.
Like a calculator function?
Oh, absolutely. Financial calculators are built for this. You'd input N equals 8 for the periods, IY equals 5, the 5% periodic rate, PMT equals 4.50, the payment, and FV equals 100, the face value.
Okay.
Then you hit compute PV, and it would tell you the present value is approximately $96.77.
$96.77. Okay, so even though the bond will eventually pay back $100 plus all those coupons, $36 total, it's only worth about $96.77 today.
Oh.
Why? Because the market wants a 10% return, and this bond's only paying 9%.
Exactly. The price is lower. It's trading at a discount to compensate the buyer for that lower coupon relative to the current market yield.
Makes sense.
And you asked about manual calculations. You can do it with a formula summing up each discounted cash flow. It just takes longer. There's also a specific formula for the present value of an annuity, which handles the stream of identical coupon payments that can speed things up a bit if you're doing it by hand.
Right. That's super helpful for understanding why bonds trade above or below their face value. Now, let's switch gears slightly. Treasury bills or T-bills. You mentioned their yield is calculated differently. How come?
Yeah, T-bills are different. They're short-term government debt, usually less than a year, and crucially, they don't pay coupon interest.
No coupons. So how do you make money?
They're sold at a discount to their face value, and then they mature at that face value. So you buy it for, say, $99, and a few months later, you get back $100. Your return is purely that difference.
Ah, okay. Simple enough, just the difference between purchase price and face value.
That's the basic idea. The yield calculation reflects that. It's usually quoted as an annualized percentage, taking into account the discount amount, the price you paid, and how many days until it matures.
So a different formula, because there are no Cs, no coupon payments.
Exactly. The formula for T-bill yield is typically yield face value purchase price. Purchase price times 365 days to maturity times 100%.
Okay, let's try an example. You mentioned an 89-day T-bill bought at $99.50. Face value is usually $100, right?
Right. So plug in the numbers. $199, $99.50, 365, 89, 100%.
Okay, 0.50 difference. Divided by 99 tells 365.89.
Yeah, it simplifies to about $59.50, $99.50 times roughly 4.101 times 100%, which gives a yield of approximately 2.061%.
2.061%.
Got it.
And the other example. The 2025 scenario, a 91-day Government of Canada T-bill at $99.20.
Same process. $199.20, $99.20, $320 divided by $99.20 times about 4.011.
Right. Works out to roughly 3.235% yield. So even small dollar discounts can translate into decent annualized yield because the holding period is so short.
Makes sense. It's all about that quick turnaround at face value. Okay, T-bill's done. Now back to regular coupon bonds. What about current yield? How's that different from the main yield we calculated earlier, the PV one?
Yes. Current yield is much simpler. It's just a quick snapshot. It looks at the annual coupon income the bond provides relative to its current market price.
So just annual cash flow divided by current price. Pretty much. Formula is annual coupon payment, current market price, 100%. It completely ignores any potential capital gain or loss if you hold to maturity, and it doesn't account for the time value of money like the PV calculation does. It's just Income right now versus price right now.
Okay, a quick and dirty measure. Let's use our example bond again.
Yeah.
4-year, 9% semi-annual, trading at $96.77. What's its current yield?
Okay, the annual coupon is $9, 2 payments of $4.50. The price is $96.77. So current yield is $96.77, 100%. That's about 9.30%.
Well, 9.3%. Okay, so the coupon rate is 9%, but because you're buying it cheaper at $96.77, the current yield is a bit higher. You get the same $9 income on a smaller investment.
Exactly. That's a good way to put it. Now that brings us to the big one, yield to maturity, or YTM.
YTM. Okay, this is the one people usually mean when they just say bond yield, isn't it?
Yeah.
The total return you expect if you hold it all the way.
Yes, generally. That's a good working definition. It accounts for everything, all the coupon payments you'll receive, plus the difference between your purchase price and the face value you get back at maturity, your capital gain or loss. It assumes you hold the bond until it matures and that you reinvest all the coupon payments at the YTM rate itself.
Ah, that reinvestment assumption seems important. We should come back to that.
Definitely. But essentially, YTM is the single discount rate that are in our PV formula that makes the present value of all the bond's future cash flows exactly equal to its current market price.
So it's like solving the PV formula backwards. We know the price, the coupons, the face value, the time, and we're solving for the interest rate that makes it all balance.
That's precisely it. And doing that by hand is, well, frankly, a pain. It usually requires trial and error or more advanced math. That's why everyone uses financial calculators or software.
Right. You had the calculator steps for our example bond again, solving for the yield this time.
Yep. Same bond. N8, PMT 4.50V, PV 96.77. Notice the negative sign. It's a cash outflow to buy it, FE 100. Then you compute IY.
And what does it give?
It gives you 5, approximately 5%. But remember, that's the semi-annual rate because we use semi-annual inputs, N8, PMT 4.50.
Right. So the annual YTM is roughly double that, 10%.
Exactly, around 10%.
And that makes intuitive sense, right?
Right.
We bought the 9% coupon bond at a discount, $96.77. So our total yield over the 4 years should be higher than 9%. We get the 9% coupon plus that capital gain when it matures back at $100.
Precisely. The YTM captures that total return. Now, there's an approximate manual formula for YTM. It's not perfect, but it gets you pretty close without needing the calculator function.
Okay, you had that written down too. It looked a bit messy.
It's a bit more involved, but it shows the components. Approximate YTM is roughly annual coupon plus face value current price, years to maturity divided by first value plus current price 2.
Okay, numerator is like average annual return. Denominator is average investment value. Kinda.
That's the intuition, yeah. If you plug in the numbers for our example bond, it gives you an annual approximate YTM very, very close to that 10% we got from the calculator. Useful if you're stuck with that one.
Good to know. And you mentioned something key. If a bond happens to be trading exactly at its face value at par, what happens to all these yields?
Ah, yes. If a bond trades at par, say $100 price for $100 face value, then the coupon rate, the current yield, the approximate YTM, and the actual YTM are all the same.
Makes sense. No discount or premium means the coupon rate is the total return.
Exactly. Now, about that reinvestment assumption you flagged.
Yeah, reinvestment risk. What's the danger there?
Okay, so YTM assumes you can reinvest every coupon payment you receive at that same YTM rate until the bond matures. But reality is different, right? When you get a coupon, market interest rates might have changed.
Right, rates could be lower.
Exactly. If rates have fallen, you'll have to reinvest that coupon money at a lower rate than the original YTM calculation assumed. This means your actual realized total return over the bond's life could end up being less than the YTM you calculated when you bought it.
Ouch. So the YTM is more like an estimate based on a potentially unrealistic assumption.
It's the expected return if rates stay the same, which they rarely do. Conversely, if rates rise after you buy the bond, you might reinvest coupons at higher rates, and your actual return could exceed the original YTM.
Interesting. And you mentioned zero coupon bonds avoid this.
Right. Since they don't pay any coupons before maturity, there's nothing to reinvest. So no reinvestment risk with zeros. Their calculated yield is much more certain, assuming you hold to maturity.
That's a really important nuance. Okay, so we've got a handle on calculating prices and different yields. Now let's zoom out again. What actually drives these prices and yields? We need to talk about the term structure of interest rates and the yield curve.
Absolutely. Bond prices and yields aren't set in a vacuum. They're driven by broad economic forces, supply and demand for money, market interest rate levels.
And you brought up the idea of the real rate of return. Why is that important to distinguish from the nominal rate?
Well, the nominal rate is the rate you see quoted, like that 10% YTM. But what really matters is your return after accounting for inflation, right? Inflation eats away at the purchasing power of your money.
Uh,
The real rate of return is what you have left after inflation. The Fisher effect gives a simple approximation. Nominal rate is roughly equal to the real rate plus the inflation rate.
so if my bond yields 6%, but inflation is 4%, my real return, my actual gain in purchasing power, is only about 2%.
That's the gist of it. And the real rate itself is influenced by things like the supply and demand for funds in the economy, where we are in the business cycle, and, importantly, unexpected shifts in inflation.
Okay, now the yield curve. You hear this mentioned constantly in financial news. What exactly is it showing us?
The yield curve is basically a graph. It plots the yields of bonds that have similar credit quality, like all government bonds, but different maturity dates. This is all at one specific point in time. Yield is on the vertical axis, time to maturity on the horizontal.
And what does a normal yield curve look like?
Typically, normal is upward sloping, meaning bonds with longer terms to maturity have higher yields than bonds with shorter terms.
Why is that the norm?
Well, the thinking is investors generally demand a higher return for tying up their money for longer. There's more uncertainty further out about future inflation, future interest rates. So you need a bit more compensation, a premium, for taking on that longer-term risk.
Okay, you mentioned a 2025 scenario with a steeply upward sloping curve. What would that signal?
A steep upward slope often signals that the market strongly expects interest rates to rise significantly in the future. Short-term yields might be low now, but investors demand much higher yields on long-term bonds to compensate for locking in money when rates are expected to climb.
Like that example. 1 year at 4.5%, 10-year at 5.5%, 30-year at 6.0%. That gap shows big expectations of future hikes.
Exactly. The shape tells a story about expectations.
So speaking of expectations, you mentioned 3 main theories trying to explain the yield curve shape. Let's start with the expectations theory.
Right. The expectations theory basically says that long-term interest rates are just an average of what the market expects short-term interest rates to be in the future.
How does that work?
The idea is an investor should be indifferent between buying, say, one 5-year bond today versus buying a 1-year bond today and then another 1-year bond next year and so on for 5 years. The total expected return should be roughly the same.
Okay, so if people expect short-term rates to go up in the future, that pushes up today's long-term rates, making the curve slope upwards.
Precisely. And if the market expects short-term rates to fall, long-term rates would be lower than short-term rates, leading to a downward sloping or inverted yield curve. A humped curve might mean expectations of rates rising, then falling.
You had an example. A 2-year bond yields 5%, and the current 1-year bond yields 4%. How does expectations theory predict the 1-year rate next year?
Okay, so the theory implies the return from the 2-year bond, roughly 1.05 squared minus 1 is 10.25% total return, should equal the return from the 1-year bond, 1.04, followed by reinvesting in a new 1-year bond next year at some future rate X.
Right.
So 1.1025 should equal 1.04 times 1 plus X. Solving for X gives you about 6.01%. So the theory implies the market expects the 1-year rate to jump to around 6% next year.
Wow. So the curve itself embeds these forecasts.
Yeah.
Okay, what's the second theory? Liquidity preference.
Liquidity preference theory adds another layer. It says, yeah, expectations matter, but also investors just generally prefer shorter-term bonds. They're less risky, more liquid, easier to sell without a price hit.
Okay, so they need an extra incentive to hold long-term bonds.
Exactly. That incentive is a liquidity premium. Longer-term bonds have to offer a slightly higher yield than what expectations alone would suggest, just to convince investors to give up that liquidity and take on more price risk.
So this theory helps explain why the curve is usually upward sloping, even if expectations are flat, because of that built-in premium.
Correct. It provides a strong reason for the typical upward slope, but it doesn't really explain inverted curves on its own. If investors always demand a premium, why would long rates ever be lower than short rates?
Good point. Okay, theory number 3, market segmentation.
Market segmentation theory takes a different view. It suggests the bond market isn't one big integrated market, but rather several distinct segments based on maturity short-term, medium-term, long-term.
And different investors stick to different segments.
Largely, yes. Think about it. Banks might need short-term assets to match short-term deposits. Pension funds and life insurers with long-term liabilities might prefer long-term bonds. These different investor groups focus on their preferred maturity habitat.
Okay.
So, according to this theory, The yield for each segment is determined primarily by the supply and demand within that segment, somewhat independently of the others.
So if there's huge demand for long-term bonds from pension funds, but not much supply, long-term yields could be low, even if short-term rates are high.
Exactly. This theory can explain any shape of the yield curve, upward, downward, flat, humped, because it depends on the specific supply-demand dynamics in each separate maturity bucket.
Okay, that's really helpful context on the bigger picture.
Yeah.
Now let's bring it back down to individual bonds. How do changes in these market interest rates actually affect bond prices? You outlined some fundamental properties.
Yes, and the absolute number one principle, the most critical one, the inverse relationship between bond prices and interest rates, or yields.
Right, we keep circling back to this, but let's nail it down. When market interest rates go UP, prices of existing fixed-rate bonds go down.
Correct.
And when market interest rates go down, bond prices go UP.
Precisely. Think about it logically. You own a bond paying 3%. Suddenly, new bonds just like yours are being issued paying 4%. Is anyone going to pay full price for your 3% bond anymore?
No way, why would they?
Exactly. To make your bond attractive, its price has to fall below face value. That lower price boosts the total return, coupon plus the eventual capital gain at maturity for a new buyer, bringing its effective yield closer to the prevailing 4% market rate.
And the opposite, if rates fall to 2%, my 3% bond suddenly looks great and its price will get bid up above face value.
You've got it. That seesaw is fundamental. You had that example. A 3% 5-year bond initially at $100 par. What happened when market yields changed?
Right, so if market yields rose just 1%, from 3% to 4%, the price of that bond fell to about $95.51, a drop of almost 4.5%. But if yields fell 1%, from 3% to 2%, the price rose to about $104.74, an increase of about 4.7%. Clearly inverse.
Clearly. Now, another key property, the impact of maturity.
How does the time left until a bond matures affect this price sensitivity?
Longer-term bonds are generally much more sensitive to interest rate changes than shorter-term bonds, assuming everything else is equal.
More volatile. Why?
Because with a longer-term bond, you have more future payments, coupons, and the final principal that are being affected by that change in the discount rate. The discounting effect compounds over a longer period. Think of it as having your money locked in for longer, subject to rate changes for longer.
Okay, so in that example where yields rose from 3% to 4%, the 5-year bond dropped 4.5%. What about a 10-year bond with the same 3% coupon?
The 10-year bond would have dropped significantly more, in that case about 8.18%. Double the maturity, roughly double the percentage price drop for the same rate change.
Wow. Okay, so maturity really magnifies the price impact.
It does. As a bond gets closer and closer to maturity, its price sensitivity naturally decreases.
Makes sense. What about the coupon rate itself? Does that affect price volatility?
Yes, it does. And this one might seem a bit counterintuitive at first. Lower coupon bonds tend to be more volatile in percentage terms than higher coupon bonds, given the same maturity and yield change.
Wait, lower coupon means more price swing. Why? Shouldn't more cash flow make it more stable?
It's about where the bond's value comes from. With a low coupon bond, a larger chunk of its total return is tied up in getting that principal back at maturity, that single payment far in the future. Right. The present value of that distant principal payment is very sensitive to changes in discount rates. A higher coupon bond, however, gives you more cash back sooner through those larger coupon payments. Those nearer-term cash flows are less sensitive to discount rate changes, so more of the bond's value is front-loaded, making its price slightly less volatile.
Okay, I think I get it. The low coupon bond is more reliant on that far-off principal payment. So comparing two 5-year bonds when yields rise from 3% to 4%, the 3% coupon bond dropped 4.49%. What about the 2% coupon bond?
The 2% coupon bond, which would have started at a lower price anyway to yield 3%, would actually drop by a slightly larger percentage, about 4.58%. It's often a small difference, but the principle holds. Lower coupon, higher percentage volatility.
Interesting. You also mentioned that the relative change in yield matters more, and prices are more volatile when rates are low, generally.
Yeah, 2 points there. First, a 1% change in yield is a much bigger deal, relatively speaking, if rates start at 1%. It's a doubling. Then if rates start at 10%, that's only a 10% increase.
Right, the proportional change.
Exactly. Second, mathematically, the bond price yield curve is steeper at lower yield levels. This means the same absolute change in yield, say 0.5%, causes a bigger price change when yields are, say, 2% than when they are 8%. Prices are just more sensitive at low rate levels.
Okay, and one more thing. Prices react more strongly to rate cuts than to rate hikes of the same size.
That's right. It's related to that curve shape. Again, it's convex. So for our 3% 5-year bond example, a 1% yield increase caused a 4.49% price decrease. But a 1% yield decrease caused a slightly larger 4.74% price increase. Not symmetrical.
Fascinating. Okay, so to tie all the sensitivity together, maturity, coupon yield level, you introduce duration. This sounds like a key metric.
It really is. Duration is a single number that tries to capture a bond's overall price sensitivity to interest rate changes. It cleverly combines the effects of maturity and coupon payments.
And how does it work? What does the number tell us?
The most common interpretation, Macaulay duration, is a weighted average time until the bond's cash flows are received. But more practically, a related measure called modified duration gives you an estimate. It approximates the percentage change in a bond's price for a 1% or 100 basis point change in interest rates.
Okay, so if a bond has a modified duration of, say, 8, and interest rates go up by 1%, its price should fall by roughly 8%.
That's the rule of thumb, yes. Higher duration means higher price sensitivity, more interest rate risk. Lower duration, less sensitivity.
So it's a really useful tool for managing risk. If you think rates are going down, you might want bonds with higher duration to get more price pop.
Exactly.
And if you think rates are heading up, you'd prefer lower duration bonds to minimize the price drop.
That's the classic duration strategy. You had that example. Bond A, duration 10, price $1,000. Bond B, duration 5, price $1,000. If rates rise 1%.
Bond A's price drops by about 10% or $100. Bond B's price drops by only 5% or $50. Really shows the difference duration makes.
Precisely. It quantifies that interest rate risk based on the bond's specific characteristics. Very important for portfolio managers.
Okay, great. We've covered a ton on pricing, yields, and sensitivity. Now, let's shift to the market itself. How do these bonds actually get bought and sold? The trading mechanics.
Right. The bond market generally has two sides, the sell side and the buy side.
Sell side. Those are the dealers and investment banks.
Exactly. They create, underwrite, distribute, and trade bonds. They make markets. The buy side are the investors, mutual funds, pension funds, insurance companies, hedge funds, even individuals who buy and hold these securities.
And on the sell side, you mentioned different roles. Investment bankers.
They work in the primary market, helping companies and governments issue new debt, structuring the deal, finding initial buyers.
Then traders.
They operate in the secondary market, trading bonds that have already been issued. They might trade for the firm's own account, proprietary trading, or execute orders for clients. They manage the firm's inventory of bonds.
And sales reps.
They're the client-facing people. They talk to the buy-side portfolio managers, pitch ideas, provide research, take orders, and relay them to the traders.
Got it. And on the buy side, it's mostly portfolio managers deciding what to buy and their own traders executing those decisions.
That's the typical setup, yes. Now, if you, as an individual or even a smaller institution, want to buy bonds, you generally go through an investment dealer.
Okay.
Large firms often have big institutional dealing desks that also serve retail clients. They might have a large inventory, automated systems for common trades, but also traders you can talk to for bigger or less common bonds. Smaller firms might build their own smaller inventory or act more like brokers, sourcing bonds from larger dealers for you.
And you mentioned interdealer brokers. What do they do?
They operate in the wholesale market, mainly connecting the big sell-side dealers and sometimes large buy-side institutions directly with each other. They act as intermediaries, often providing anonymity, which is crucial for very large trades. They help facilitate price discovery and execution in that institutional-only space.
Like a broker's broker, almost. For the really big players.
Kind of, yeah. Facilitating trading between the dealers.
So how does a trade actually happen? Especially for bigger or less liquid bonds.
Often, it still starts with a phone call between traders or a salesperson and a client. These calls are almost always recorded and considered legally binding commitments once terms are agreed upon.
What terms?
The specific bond, using its identifier like a HUSIP or ISINS, the quantity, face value amount, and the price or yield. Once they say done or agree, the trade is locked in. Both sides are obligated to follow through by the settlement date.
And then comes the paperwork, or the electronic equivalent, the trade ticket.
Exactly. It's the official confirmation. It details everything. Who bought, who sold, the bond details, issuer, coupon maturity, CUSIP, the face amount traded, the agreed price yield, the settlement date where the bond will be held, the custodian, and critically, the total settlement amount, including any accrued interest.
Accrued interest. We need to talk about that. But first, clearing and settlement. What happens then?
Clearing is the process where all the trade details are confirmed and matched between the buyer, seller, and potentially a central clearinghouse. Settlement is the actual exchange. The seller delivers the bonds and the buyer delivers the payment. Legal ownership transfers at settlement.
And how long does that take?
For Canadian T-bills, it's usually same-day settlement T plus 0. For most other bonds and stocks in Canada, the standard is now T plus 1, meaning 1 business day after the trade date.
Okay, T plus 1. And how are bonds actually owned these days? You mentioned different forms.
Right. Historically, there were bearer bonds, physical paper certificates. Whoever held the paper owned the bond. You literally clip off coupons and redeem them for interest. Very risky, almost non-existent now.
That's risky.
Then came registered bonds. The owner's name is recorded by the issuer or their agent. Transfers require the registered owner's signature. Interest payments are usually mailed directly. Much safer. But by far the most common form today is book-based or electronic registration. Ownership is just an electronic record held by a central securities depository, like CDS clearing in Canada. No physical certificates change hands. It's all electronic entries. Hugely efficient, makes trading much faster and easier.
Makes sense. Okay, now, accrued interest. Why does the buyer have to pay extra for that?
Think about it. Bonds pay interest periodically, say, every 6 months. If you sell your bonds somewhere between those interest payment dates, you've earned some interest since the last payment date, even though you haven't received it yet.
Right. I held it for part of the period.
Exactly. So when you sell it, the buyer has to compensate you for the interest that has accrued during the time you held it in that current coupon period, up to the settlement date. The buyer pays the agreed market price plus this accrued interest. Then, on the next official coupon payment date, the new owner, the buyer, receives the full coupon payment from the issuer.
Oh, okay. So the buyer is essentially prepaying the seller for their share of the upcoming coupon payment. It nets out for the buyer later.
Precisely. It makes sure the interest income is allocated correctly based on who held the bond during which days.
And how do you calculate it? There was a formula.
Yep. Accrued interest, annual coupon rate, number of coupon payments per year, number of days since last coupon payment up to settlement date, total days in that coupon period, par value traded. You need a calendar and the specific day count convention for that bond market.
Okay. You had a detailed example. An 8% Government of Canada bond, $200 K par value, bought May 8th, settles May 9th, last coupon was March 15th. Walk us through the days.
Right. So last coupon was March 15th. We count the days from the day after the last coupon, March 16th, up to and including the settlement date, May 9th. Let's recheck that calculation standard. Typically it's up to, but not including settlement. Let's assume that for now. So March 16th to March 31st is 16 days. April has 30 days. May 1st to May 8th, not including 9th, is 8 days. Total equals 16 plus 30 plus 8 plus 8 plus 84 days.
54 days of accrued interest.
Exactly. The bond pays semi-annually. Let's assume the period March 15th to Sep 15th has 184 days. Need to check actual calendar, but as an example. The semi-annual coupon rate is 8% to Excel's 4%. So accrued interest, it's at 0.84, 5,484, $200,000.
Okay, let's see. 4% times 54 divided by 184 times 200,000.
Comes out to approximately $2,347.83 in this example calculation. The exact number depends on the specific day count convention used, like actual or 3360, etc., but that's the principle. The buyer pays the seller this amount on top of the bond's price.
Got it. Ensures fairness between coupon dates. Okay, last major topic. Bond indexes. What are they and why should we care?
A bond index is basically a benchmark. It's designed to represent and measure the performance of a specific segment of the bond market over time, like a portfolio representing, say, all Canadian government bonds or all U.S. high-yield corporate bonds.
So analogous to stock market indexes like the S&P TSX Composite or the S&P 500, but for bonds.
Exactly the same concept. They have several important uses. One, they tell us how a particular part of the bond market is doing overall, are prices up or down. Two, they're used as benchmarks to measure the performance of active bond portfolio managers. Did the manager beat the index?
Right. Performance comparison.
And three, they form the basis for index funds and ETFs. Passive investing vehicles that simply aim to track the performance of a specific bond index, offering diversification at low cost.
Makes sense. What are some key Canadian bond indexes people might hear about?
The big one is the FTSE Canada Universe Bond Index. It's the broadest measure of the Canadian investment-grade fixed income market. Includes federal, provincial, and corporate bonds denominated in Canadian dollars with at least 1 year to maturity.
How is it constructed?
It's typically capitalization weighted, meaning bonds with larger amounts outstanding have a bigger weight in the index. And it measures total return that includes price changes and the reinvestment of coupon income. There are also many sub-indexes: short-term, mid-term, long-term, corporate, federal, provincial, etc.
Okay. And globally, any major indexes to be aware of?
Oh, lots. Some big ones include the FTSE World Government Bond Index, WGBI, for developed market government bonds. The Bloomberg U.S. Aggregate Bond Index, the AGG, is the main benchmark for the U.S. investment grade market. For emerging markets, there's the J.P. Morgan MBI Global, and for lower-rated corporate bonds, maybe the Credit Suisse High Yield Index. Many others exist too.
So these indexes provide a crucial map and ruler for navigating the huge world of bonds.
Absolutely. They bring transparency and comparability to a market that can otherwise seem pretty opaque.
Well, this has definitely been a comprehensive deep dive. We've really unpacked a lot today about bond pricing and trading.
We certainly have.
We covered present value as the foundation, dug into calculating various yields like current yield and YTM, explored the yield curve and the theories behind its shape.
Talked about the key factors driving bond price sensitivity rates, maturity, coupon duration as a measure of that.
Right. And then the practical side, how trading actually works, the sell side, the buy side, settlement, accrued interest, and finally the role of bond indexes as benchmarks.
It's a lot, but hopefully broken down into manageable pieces. Understanding these fundamentals really does give you valuable insight into how a huge part of the financial world operates.
Absolutely. Hopefully this has demystified things for you, our listener, and given you that solid base. Now here's maybe a final thought to chew on. With this foundation, how might you start thinking differently about the interplay between interest rates, inflation expectations, and bond prices when you hear economic news? How might these concepts influence broader investment strategies in the current climate?
That's a great question to ponder. This deep dive has hopefully equipped you with the tools to start connecting those dots and continue exploring the fascinating world of finance.